Welcome to the Deep Dive, where we take a stack of information and distill it down to the most important nuggets, saving you time and giving you those aha moments. Today, we're plunging into the rapidly evolving tax landscape across the Gulf Cooperation Council, or the GCC, with a sharp focus on the latest changes and what they really mean for you.
Yeah, absolutely. We've brought together insights from, well, a wealth of sources, everything from specialized tax newsletters and official government announcements to, expert analyses from leading firms like Premier Brains, LexisNexis, KPMG, and Grant Thornton. Our mission today is really to cut through the complexity. We'll highlight the significant shifts in corporate tax, the accelerating digital transformation of tax compliance, and other crucial updates that could directly impact businesses and individuals operating in or engaging with this dynamic region.
That's right. Whether you're trying to prep for a critical meeting, stay updated on the latest in the tax world, or simply curious about how global and regional dynamics are shaping economies, this deep dive is crafted just for you. We'll explore everything from the UAE's brand new corporate tax to cutting-edge e-invoicing systems and even surprising tax incentives for electric vehicles. Okay, let's unpack this. Let's kick things off with the United Arab Emirates. They've seen some of the most significant tax developments recently, especially with their new corporate tax law, often simply called the CT law.
Right, and what's fascinating here is just how broadly the UAE CT law is being applied. I mean, initially, many businesses and individuals might have thought, okay, this is just for large corporations. But Cabinet Decision No. 49 of 2023 made it really clear. Even businesses or professional activities conducted by natural persons, individuals like consultants, freelancers, sole proprietors, they're now within scope if their total annual revenues exceed AED 1 million. That's a crucial detail, really fundamentally changing the landscape for individual entrepreneurs and professionals operating there.
Right, 1 million AED. And this next point on free zones, I mean, this feels like a game changer for many. It fundamentally alters a long-held assumption about operating in the UAE, doesn't it?
Yeah.
Historically, these have been, well, bastions of 0% tax, but the new CT law means that's no longer a blanket assumption.
Exactly. The ministerial and cabinet decisions, particularly number 139 and number 55 of 2023, are absolutely key here. They've precisely defined which types of activities do qualify for that 0% corporate tax rate. It's primarily focusing on specific industrial, manufacturing, and certain high-value service sectors like reinsurance, wealth management, or even ship operations. Think of it as a targeted incentive, not quite the general one people might have expected.
Okay, so targeted.
Yeah, and conversely, certain financial services like banking or most direct transactions with natural persons are now explicitly excluded from that preferential rate. There's also a de minimis rule, which is a small buffer, you could say. A qualifying free zone person can still get the 0% rate even if a tiny portion of their revenue, specifically the lower of AED 5 million or 5% of their total revenue, comes from non-qualifying activities. A surprising point for many, I think, is that the terms onshore and offshore income, which were discussed during earlier consultations, aren't actually in the final legislation. This means the focus is purely on the nature of the activity and where it's conducted. And a major pending question remains, exactly which specific free zones will be officially classed as designated free zones, as this impacts key activities like, say, the distribution of goods.
Got it. So this new corporate tax undoubtedly changes the M&A landscape. From your perspective, what's the most significant shift dealmakers need to consider in the UAE now? And what are some common pitfalls they might be encountering?
Well, this raises a really important question for anyone involved in mergers and acquisitions. The introduction of corporate income tax, it fundamentally reshapes company valuations and transaction structures. It just does. Increased tax costs directly diminish profit margins and cash flows, influencing, well, every negotiation. Whether you're looking at a share deal where a buyer acquires the company's shares and takes on existing tax risks, but might benefit from tax loss transfers, or an asset deal where specific assets are purchased and the target's liabilities generally aren't transferred, the tax implications are now paramount. The UAE CT law does allow tax losses to be carried forward, which is good news, but only if at least 50% ownership is maintained. So that's a key condition.
And what about preventing avoidance?
Right. The UAE has also introduced anti-abuse provisions to prevent purely tax-driven transactions from undermining the new law. It's about substance over form, and the timeline is quite tight for some. Companies with accounting years starting on June 1st, 2023 are already impacted, and those anti-abuse rules even apply to transactions initiated after October 10th, 2022. This means due diligence, it's become even more critical than before.
So we covered the major shifts in corporate tax, or I imagine the devil's in the details, as they say. What kind of specific clarifications have businesses been looking for from the Ministry of Finance? And what key guidance have they provided to help companies actually operationalize this new law?
Yeah, good question. To operationalize these broad new tax laws, the Ministry of Finance has been, well, quite busy issuing a series of crucial ministerial decisions. You can think of them as the detailed instruction manual. For example, they've now specified the exact accounting standards businesses must follow, primarily mandating IFRS, though with some exceptions. They've also provided clear guidelines on how to form tax groups, which is, crucial for larger enterprises with multiple entities seeking consolidated tax treatment. Another critical area is the detailed guidance on transfer pricing documentation. They've set clear thresholds for when businesses need to prepare local and master files. And this isn't just about paperwork. It means companies hitting these revenue thresholds really need to demonstrate their pricing is truly arm's length or face significant scrutiny and potential penalties.
So a lot of detailed rules coming out.
Exactly. There's also been extensive guidance on things like participation exemption rules for holding companies, adjustments for opening balance sheets under transitional rules, and the general interest deduction limitation. A more recent update, Ministerial Decision Number 261 of 2024, which actually superseded an earlier one, brought important clarity for unincorporated partnerships, foreign partnerships, and family foundations, basically simplifying their compliance by confirming their tax transparency. These decisions are all about providing certainty and, where possible, reducing compliance burdens.
Okay. And how does this fit into the global picture?
Well, importantly, the UAE is also aligning with global efforts to prevent profit shifting. The Ministry of Finance confirmed that a domestic minimum top-up tax, or DMTT, based on the OECD's global rules. That's essentially a global initiative to ensure large multinational enterprises pay a minimum effective tax rate of 15%. That DMTT will be effective for financial years beginning on or after January 1st, 2025 for MNEs with global consolidated revenues of EUR 750 million or more. This really shows the UAE's commitment to participating in the evolving global tax framework.
Okay, so moving on from corporate tax, let's talk about how technology is shaking up tax compliance. It seems like electronic invoicing, or e-invoicing, is becoming a huge deal across the GCC.
It absolutely is. Regulators are keen on e-invoicing as a powerful tool for digitalization, improving compliance, and, frankly, increasing tax collections. It's also often driven by a goal to reduce the tax collection gap, and even for sustainability, reducing paper use. Saudi Arabia was the first GCC country to implement this after introducing VAT, and they did it in phases, which was probably wise. Phase 1, which went live back in December 2021, required all businesses to generate and store invoices electronically. Simple enough start. Phase 2, which kicked off in January 2023, involves integrating taxpayer systems directly with the tax authority's platform, ZATCA's platform. This is being rolled out in waves to allow smaller and medium-sized enterprises time to adapt. We've seen ongoing waves announced extending well into 2025, progressively bringing in companies with lower revenue thresholds. The key requirements, they include updating invoice templates to capture additional info like timestamps and QR codes, and for B2C, business-to-consumer supplies, reporting all invoices daily to the tax authority's portal via an authorized API. Non-compliance, as you can imagine, can lead to hefty fines.
Right. So what about other GCC countries? Are they following Saudi Arabia's lead on this digital front? Is everyone jumping on the invoicing train?
It looks like it. Bahrain appears to be next with an official request for proposal, an RFP, already issued for an e-invoicing regime. The UAE Ministry of Finance also recently announced 5 major strategic initiatives, and one of them explicitly includes an e-invoicing system. What's kind of unique about the UAE's approach, though, is its adoption of the decentralized 5-corner model from PEPL. In simple terms, this means that unlike some systems where the tax authority pre-clears every single invoice, here, invoices are exchanged directly between suppliers and customers. They go through accredited service providers without needing pre-clearance from the Ministry of Finance or the Federal Tax Authority, the FTA. This model is based on an international framework called PEPL, which helps standardize secure electronic document exchange globally. So they're leveraging an existing standard.
Interesting. So direct exchange. Who does this apply to?
This system will apply to B2B, business-to-business, and B2G, business-to-government transactions, regardless of VAT registration status. It's set for a phased rollout. Accreditation for those service providers is expected in Q4 2024, legislative updates in Q2 2025, and the Phase 1 reporting go-live is targeted for Q2 2026. The potential benefits are significant. Think automatic pre-population of VAT returns, faster refund processing, reduced errors, maybe faster payments, and access to a wider international network through PEPL. And just quickly, for tourists, a fascinating development in the UAE is the launch of the world's first VAT refund system for e-commerce retail purchases. Tourists can apply for refunds directly through e-commerce platforms registered with the FTA, simply by providing travel document details at purchase time and verifying identity during delivery. Pretty neat.
Wow, okay. That e-commerce refund sounds innovative. But stepping back, this e-invoicing transition sounds like a massive undertaking for businesses. What are the biggest hurdles companies face when adopting these new digital tax systems? And what should you be doing to prepare right now?
You're right. It's a large-scale digital transformation, no doubt about it. Common challenges include selecting the right solution and, importantly, the right implementation partner. And critically, ensuring adequate training for all end users, not just the IT and finance departments. We've seen how errors stemming from inadequate training can unfortunately lead to penalties. Significant changes to existing ERP systems are often required. You need to capture and format data correctly for the tax authorities, including things like generating those QR codes and segregating B2B and B2C invoices properly. For businesses, the immediate action items are, well, first, closely monitor official announcements. Then, clearly define their digital strategy for tax compliance, assess their current readiness, where are the gaps, standardize their data entry processes, and implement robust internal controls. It really requires leadership buy-in and, yes, significant investment in upskilling the workforce.
Makes sense. Okay, let's widen our lens a bit to other significant tax updates across the GCC. What's standing out in Oman, for instance?
Oman is making some interesting moves, particularly towards environmental incentives and consumer protection. They've announced a pretty compelling set of tax exemptions for electric vehicles, EVs, and also their spare parts, exemptions from VAT, customs tax, and even registration fees. Now, this is provided the vehicles are fully electric or hydrogen-powered, registered as zero-emission in Oman, meet local specifications, and are purchased from VAT-registered entities within Oman. It's a clear signal of their commitment to sustainability. They've also launched an app called ZATCA to combat counterfeit goods. It allows consumers to verify tax stamps on products, particularly things like cigarettes and tobacco. This connects to broader themes of compliance enforcement and, protecting consumers.
Right, interesting on the EV front. Now, I've heard about unique tax rules in Kuwait. Can you unpack their tax retention system? I understand it's often misunderstood.
Ah, yes, Kuwait's retention system. This is a critical nuance, and you're right, it can often be a bit of a head-scratcher for foreign companies. Kuwait has a distinct tax retention system. Here's basically how it works. Every entity doing business there must retain 5% of the total contract value or 5% from each payment made to their contractors or vendors. This retained amount is held by the payer, by you, until the vendor provides something called a retention release letter, an RRL, from the Kuwait Ministry of Finance. Now, the key takeaway for you, the listener, is that this 5% is not a withholding tax. I repeat, not a withholding tax. It does not exempt a foreign company from its own separate tax filing obligations in Kuwait. Many foreign companies make the mistake of assuming it does, and that leads to compliance issues down the line. In fact, if you, as the payer, fail to make these necessary retentions, Minister of Finance can actually demand that tax debt directly from you if the payee fails to settle their taxes later on. So it's really an assurance mechanism for the government, not a final tax payment made on behalf of the vendor.
Got it. That's a really important distinction. Okay, what's new on the compliance front in Saudi Arabia, beyond the invoicing we already discussed?
Well, beyond the ongoing e-invoicing waves, ZATCA, the ZATCA Tax and Customs Authority in KSA, has provided clearer guidance on the taxation of non-residents providing services, especially where double tax treaties exist, trying to clarify those interactions. They've also simplified the guide for taxpayer's identification number, or EGIN, deregistration, making that process clearer. And they've updated real estate transfer tax, RETT, exemptions, extending them to transfers involving Saudi investment funds under certain specific conditions. A significant update, I think, which provides more certainty for taxpayers, is that tax rulings issued by ZATCA are now formally binding. That's a big step towards predictability. Plus, a minor but important VAT change means online stores operating in KSA must now display their VAT registration certificates, making it easier for consumers to verify their compliance.
And Bahrain. You mentioned e-invoicing, but are they also joining the global trend of corporate taxation like the UAE?
Yes, absolutely. Bahrain plans to apply corporate tax on companies at a minimum rate. This is largely driven by the global push from the OECD's Pillar 2 framework, similar to the UAE's DMTT. This domestic minimum top-up tax, or DMTT, applies a 15% effective tax rate to multinational enterprises, MNEs, with global consolidated revenues of EUR 750 million or more in at least 2 of the previous 4 fiscal years. Pretty standard definition. It's set to be effective from January 1st, 2025. And Bahrain is actually the first GCC country to implement legislation explicitly aligned with these global rules, highlighting its proactive stance in adopting these global standards. Failure to register for this DMTT can lead to penalties up to BHD 100,000, so it's a significant development for large multinationals operating there.
Right, keeping pace with global standards. Speaking of global trends, it seems like there's a lot of activity around double taxation agreements across the region as well.
There really is. If we connect this to the bigger picture, the sheer number of new or amended double taxation treaties, DTTs, being signed across the GCC is fascinating. It really points towards greater integration. These treaties, as you know, are vital for preventing income from being taxed twice in different countries and providing clarity and protection for international businesses and investors. Oman, for example, has ratified treaties recently with Egypt, Cyprus, and Tanzania, and signed new ones with Russia and Luxembourg. Bahrain signed one with Guernsey. Kuwait has an amending protocol with South Africa that's entered into force, covering things like dividends, interest, and capital gains. Qatar has signed a DTT with Uzbekistan and ratified a protocol with Ukraine. And the UAE, not to be outdone, also has a comprehensive economic partnership agreement, or CEPA, with Turkey, which often includes tax elements, and is currently negotiating a DTT with Russia. All this activity signifies a growing integration into the global tax framework and demonstrates clear efforts to enhance transparency and protect investors, making the region arguably even more attractive for international business.
That makes sense. And finally, one last area. How does the broad concept of environmental, social, and governance ESG, how does that intersect with tax in the GCC? It's not something many people immediately link together.
Yeah, that's a great question, and it's becoming increasingly relevant. While explicit environmental taxes are still, let's say, limited in the GCC, Oman's EV exemption is a notable outlier, ESG strategies are definitely impacting tax. Consider the governance aspect of ESG. This is where tax transparency comes in strongly. Mandatory reporting requirements like the OECD's country-by-country reporting, CDCR, and the EU's D6 directive on reportable cross-border arrangements are now impacting some GCC-based groups that have operations in the EU. This means they need to provide much more detailed tax information to authorities, which wasn't always the case. The social aspect links to how companies contribute to society through their tax payments and ensuring fair tax practices. It's not just about strict compliance anymore. It's increasingly about reputation and sustainable business practices. The Saudi exchange, Tadawul, for instance, even includes tax transparency in its ESG guidelines. They actually assess companies on their effective tax rate and any significant tax controversies. Now, companies are certainly facing data gathering challenges for these disclosures, but it's becoming crucial for their overall reputation and, importantly, for demonstrating sustainable practices to investors and other stakeholders.
Okay, so ESG and tax are definitely becoming intertwined. With all these swirling changes and new laws, digital shifts, global pressures, how can businesses and individuals get clarity on their specific tax situations in the UAE? It sounds like a pretty complex landscape to navigate right now.
You're right. Navigating this complexity is absolutely key. The UAE Federal Tax Authority, the FTA, offers a really valuable mechanism called private clarifications through its online portal, Ameritax. Essentially, this is an official written document from the FTA that responds to your specific request about the tax treatment of a particular transaction or situation, providing you with binding certainty on that matter. Now, there is a fee involved. It's AED 1,500 for a single tax matter, or AED 2,050 if your question relates to more than one tax type, say VAT and corporate tax, within the same specific matter. These fees are generally non-refundable, and only eligible persons can apply. That means the taxpayer themselves or their officially registered tax agent or legal representative. The request itself must contain specific details, including your own technical interpretation of the law and any alternative tax treatments you've considered. You have to show you've thought about it. The FTA can reject requests, for instance, if the matter is already clearly clarified in public guidance, if it's a duplicate request, if it relates to a purely hypothetical scenario, or, importantly, if it's suspected to be part of tax planning, avoidance, or evasion schemes. Also, clarifications related to corporate tax can generally only be requested by persons already registered for corporate tax, unless, of course, it's a query about the registration process itself. This process gives you a direct line to official guidance, and the clarifications are typically issued within 50 business days for indirect taxes like VAT and 60 business days for corporate tax. So it's a defined process.
That sounds like a very useful tool for getting certainty. And what about just ensuring your existing tax records are up to date? With all this change, it sounds like a good time for a compliance check.
It absolutely is. And the FTA seems to agree. They've actually granted a valuable grace period running from January 1, 2024, all the way through to March 31, 2025. During this period, you can update your existing tax records, things like your registered name, address, or your listed trade license activities without incurring administrative penalties for late updates. And even better, any penalties that might have already been imposed during this period for these specific types of updates will be automatically reversed by the FTA. This is really a clear signal from the FTA encouraging businesses to get their house in order, and it's a fantastic opportunity for you to ensure everything is perfectly accurate and compliant without facing extra costs. Definitely worth taking advantage of.
Wow, okay, that was a truly comprehensive look at the whirlwind of tax changes across GCC. I feel like we covered a lot of ground. From the intricacies of the UAE's new corporate tax, especially how it impacts individuals in free zones, to the rapid digitalization with e-invoicing, and those strategic considerations for M&A, it's clear the region is embracing a new era of global tax standards.
Indeed. We've seen how these shifts are not just about compliance, are they? They're also tied into broader economic goals, things like fostering transparency, attracting investment, and even supporting sustainability, as we saw with Oman's EV rules. The sheer volume of new legislation and decisions really highlights the ongoing dynamic nature of tax in the GCC. It's definitely moving towards greater alignment with global norms while still retaining some unique regional characteristics, like Kuwait's retention system.
So, what does this all mean for you listening in? Well, it means staying informed is more crucial than ever. Things are moving fast. With all these changes swirling around, what's one area of your business or perhaps your personal finances that you'll be looking at with fresh eyes, given these new tax realities? Maybe it's time to review your free zone activities in the UAE, or perhaps reassess your readiness for e-invoicing wherever you operate in the GCC. Definitely something to chew on until our next deep dive.